Well, the GST Council has finally taken a call to implement lower revised GST rates for all new projects and for new buildings coming up in ongoing projects from 1st April 2019, making it mandatory to switch to new rates. However, and this is a big however, the transition period from old to new rates is yet to be decided by the government. Meanwhile, there will be an option for developers of ongoing projects to continue with old rates, taking the advantage of passing on the input tax credit. They could also shift to new rates without input tax credit. So that choice is with the developer community. Has this decision put the real estate sector out of its misery once and for all, or are there still concerns? Before we get to the bottom of that important answer, let's listen into what the Revenue Secretary Ajay Bhushan Pandey had to say on the decision taken by the GST Council.
The projects or the residential buildings which are incomplete as on 31st March 2019, those buildings will have an option, and that option also will have to be exercised within a time limit, and that time limit will be decided in consultation with the states. So those buildings will have an option either to choose the old rate, that is 12% or 8% with input tax credit, or the new rate, that is the 5% without input tax credit or 1% without input tax credit.
The states are definitely still not on board. You have Punjab and Maharashtra still raising a lot of questions on this transition phase as well, and also questioning the basic rate itself for affordable housing in Pune and Maharashtra and Mumbai. Joining me on The Real Deal today are CMD of Hiranandani Group, Mr. Niranjan Hiranandani, Pankaj Bajaj, MD of Eldeco Infrastructure, Mr. MS Mani, his partner GST at Deloitte India, and Uday Pimprikar, he's the national leader indirect tax at EY India. It doesn't seem that the question is settled for now, Mr. Hiranandani. Our correspondent reported today that, Maharashtra and Punjab are still not on board with the decision taken. So is it smooth sailing for developers, or do you think that it's still not calling it a truce?
First of all, I don't agree that it's not smooth sailing. In fact, they have tried to cover up the transition phase of this project. Ultimately, everybody will be on the new GST rates. It's only the transition phase that will have to go under the old or the new, and the option is available to the developer. So prospectively, all the projects will go under the new rate. That's the issue that is very, very clear. Number two issue is that we had about 4 or 5 other issues in relating to the transition phase, as well as the fact that Mumbai region, MMR and other places, the 45 lakhs cap was an issue, and that has not been addressed, though I believe it was proposed that it should be, we had proposed 1 crore, but I understand the proposition which was put on the table was 60 or 70 lakhs. But that has been postponed by thinking that this cannot be taken up just now in view of the model code of conduct being operational. That would be considered as a substantial change. So I think what they've tried to do is really to see that the transitory phase of activity where input tax credit had already been accrued by the developers under the old scheme would continue for those sales which took place under the old scheme, and I think that's a correct thing to do as a transitory phase. Ultimately, everybody will be going on the 5% and 1%. So that's pretty clear to me.
All right. Okay, so 5%, 1%, there's no quibble on that. The question is, in Mumbai, what is affordable housing? 45 lakhs does not definitely qualify. That's the contention of the developers. But let's come to then the other big question. What we heard from the secretary was reasonable time for transition will be given to developers in consultation with the states. What is reasonable, Pankaj Bajaj?
I think 2 or 3 month window for us to decide. Yeah, for us to decide whether to move to the new scheme or the continue the old one.
But you don't have 2 or 3 months. 1st April, you have to either move or you don't move.
Well, then see, the clarity is not there. They said that in a prescribed time frame, we will have to move to either to the new scheme for the ongoing projects or continue with the old one. Now, what that prescribed time frame is, we do not know. So I'm saying, I am guessing that because of the ongoing projects, ongoing election scene and stuff, there would be a 2-3 month window before which things become clear.
But you're happy with the transition,
Yeah,
and what you had asked for is now settled?
Absolutely. Simply moving on to the new regime of 5% would have been unfair to developers, because it would have been tantamount to changing the law with retrospective effect, because they passed on the input credit in their sales. So, but now that optionality has been given to the developers, that you can continue with the ongoing projects with the old regime. So I think it couldn't have been more fair.
All right. Mr. Mani, you think the dust is now settled? I mean, the developer community should not worry. It's pretty clear for all you consultants in this GST business. You will be able to advise developers what to do, what not to do, and it's business as usual going forward?
Okay, so as far as consultants are concerned, we have been advising in the past. I'm sure we'll continue advising in future. But on a different note, I think the only discordant voice that we have seen in this whole piece is actually on the input tax credit. And the fact that there is now a 1% rate with no input tax credit, to my mind, is very fair. I don't see any unfairness over there. But a 5% rate with no input tax credit is something which quite a few developers are still, struggling with. And on a very fundamental level, Manisha, the way I look at it is, when you have something which is termed as a GST, the fundamental premise is that each person at each level will take on credit and pass on the value chain till it reaches the ultimate consumer. Now, we have made an exception in the past in case of restaurants. There was subsequently another exception made in respect of a product called sanitary napkins. And now we are seeing the third exception being made for real estate. So to my mind, the larger issue from a tax policy perspective is, if we have value chain breakages the way we have done in real estate, which again is a sector which the government in the past has said that they would like to tax all transactions, they would like to look at the value chain, they would look at various aspects of the sector. So when we go ahead and we offer a lower rate, but curtail the input tax credit to the extent where we say no input tax credits at all, that to my mind would be a matter of concern for the sector as a whole.
According to me, that basically, it acts as the very basis of GST, isn't it? I mean, you're now creating a different sort of taxation regime and making exceptions. Restaurants, fine, they buy most of their vegetables and inputs anyway, come a lot in cash. But here, you want to actually formalize the sector. Uday, value chain breakage, 5% tax without ITC. If I do the numbers, and everyone's done the math, it actually does not even translate to cheaper end price to the customer, right? So what was it? Was it optics? Was it the industry which lobbied? For whose benefit has this been done?
So I think it is a bit of both. I think from an optics perspective, a 5% rate is more palatable, and it is more akin to what was happening possibly earlier under the old regime. Even the effective rate of tax, with a 5% is slightly more akin to what was happening earlier. Maybe a little bit more, to my mind, especially in some of the geographies. Having said that, this particular move primarily makes it more palatable. Okay. Is it a move in the right
So it is optics. Let's say accept it, Uday. This is optics. I mean, palatable to who? I think 80% of the developers were not in the favor of doing this. They're just saying, all right, it's done. We don't have a choice. If you do the math, it's very simple. There is no benefit to the buyer. In fact, the price is a little bit more. So palatable in terms of optics, isn't it? Anyway, let me come back to you. There is a CNBC-TV18 exclusive as well. We're given to understand from sources that GST Council asks a group of ministers on real estate to look into fresh concerns flagged off by Maharashtra and Punjab. Timsy, who tracks this space, is joining us. Timsy, so I believe that it's still not a smooth sail for the sector. There are some concerns that Punjab has, and Maharashtra, of course, for Mumbai has on affordable housing. Can you run us through what you're learning?
Well, to be precise, both Maharashtra and Punjab in the GST Council meeting flagged off their concerns, and the GST Council, understanding the concerns, they have now referred these issues to GOM on real estate. Specifically for Maharashtra, Maharashtra has sought clarity on how slum redevelopment should be treated when it comes to GST. Also, Maharashtra has said that the value ceiling when it comes to affordable housing, which was set in the 33rd GST Council meeting as 45 lakhs, does not suit Mumbai and Pune. For Mumbai, the ceiling should be increased to 70 lakhs, and for Pune, it should be kept at 60 lakhs. Now, this meaning a policy change, and thus government feels that the issue needs to be referred back to the GOM. When it comes to Punjab, Punjab has sought clarity on long-term lease for setting up industrial parks, which is also an integral part of Punjab and Punjab's development. So all these three issues have been referred back to the GOM on GST, on real estate. They will now reconsider, go with further deliberations, and then in the next GST Council put forward their view. The next GST Council, which is now likely to happen only after elections, will definitely look into these concerns.
Tipsy, thank you very much. So that's exactly what Mr. Hiranandani also said, that, the affordable housing limits for those cities is the thing that could go back to the GOM, but the rates are absolutely decided. Now, another very interesting aspect, and Pankaj, I'm going to ask you this. The government has said that, if you're making it mandatory for construction material to be bought from GST registered contractors, right? They're trying to plug the chain and say, okay, fine, you can't do cash deal. Right before this whole decision was taken, there was a big news article which also talked about the fact that government believes that more than 50% of the builders haven't paid their GST. Again, that strong statement coming from the government is that we will be keeping a very close eye, hawk eye, and make sure that anybody who's not passing on the benefit or is profiteering will be scrutinized.
Right.
What's going on? I mean, it still seems to be a whole lot of distrust out there.
Absolutely. I wish this distrust wasn't there. And let me say that I don't think that a lot of cash purchase does happen in the real estate market. I mean, we appoint contractors, they pay their GST, and now there's this rule that 80% of our purchases anyway have to be from registered dealers.
Contractors.
Otherwise, we have to pay the GST on that in any case in the reverse charge mechanism. So there's no incentive to be buying in cash. And where is the cash with the developer? A lot of developers...
But is this going to make it, Mr. Hiranandani, just the fact that now you can only buy from GST registered vendors, is that an issue at all, or it's a non-issue?
It's a non-issue as far as Mumbai is concerned. We are buying, I think, 90% of the material plus would be from registered buyers. So I don't think that's an issue here. But yes, in the tier 2, tier 3 cities, that is a challenge. And the smaller suppliers, which are a majority of it, don't pay GST by virtue of the fact that they are much smaller in size than what the requirement of GST is. So they are actually don't come under the cap. So I do see a problem not in Mumbai, not in Pune, not in Delhi, but I do see it in smaller towns and other places where I think this is going to be a challenge.
Mr. Mani, the push also seems to have come for this 5% and 1% from tier 2, tier 3 city developers is what I've understood and heard on the street. You believe that tier 2, tier 3 will again get into, 80%, will they be able to follow it? And is cash likely to come back into the market, at least at 20%? What's your own reading?
Okay, so when it comes to implementing the 80% purchase from registered dealer provision, I think in any case, Mr. Hiranandani is fair in saying in tier 2, tier 3 it may not be happening, in tier 1 it may not be happening. But the larger issue is even for tier 1 cities, how are we planning to implement it? Because getting this information in terms of whether 80% at a project level, 80% during a particular period, or 80% in respect of a legal entity, how do we track that? Now, most of the real estate projects have a very long gestation period. So whether the purchases in respect of a project, 80% is from a registered dealer, will actually be known only at the end of the period when the project gets completed. So that's going to be 2 to 3 years down the line. So the implementation mechanism for this 80%, added with the fact that if the purchase is not 80%, there is a reverse charge, is going to be extremely, extremely difficult. To my mind, that's going to make it even more complex than it was, before.
Yeah.
Just one point at this stage I wanted to mention is, when we speak of value chain, we just need to keep in mind that in GST, cement comes at 28%, steel, tiles, all the other products come at 18%. So when you have a 5% rate with no input tax credit, the solution is going to be very, very difficult.
I think we need to come back and elaborate on that. What happens when your input tax is so much higher than what you actually, or what benefits you've got from the reduction of the GST to the end consumer? Well, this debate on GST is clearly not over. In Manipur today, Rahul Gandhi has made a really important statement. He said that GST introduced by Mr. Narendra Modi's government is not GST. If we come to power, we will simplify it to a proper GST, which means just one tax, to which Mr. Jaitley has responded. And he said that's a stupid thing to say because, you cannot have a single tax for sin goods and non-sin goods. So have we at least achieved that regime of simplicity which GST was meant to do? Let's talk about that when we come back. And is GST the only thing that this industry needs to get back into its gear? Because really, at the moment, if you look at things with real estate sector, a lot more needs to get fixed, and they need once and for all some sort of stability coming back to the sector. Well, the dust might have settled on the GST issue when it comes to the real estate sector, but not on many other things. The sector contributes to 7% of India's GDP. It employs 14% of India's labor, or let's say people. The importance of this industry in view of job numbers, of course, NSSO released, of which Indian Express has access, shows that for the first time since 93-94, the actual size of India's male workforce, or men who are working, has shrunk. So is it time to look beyond GST and lessen the overall tax burden for this sector? Pankaj Bajaj, everybody from CREDAI to Naredco has said that we are overtaxed as a sector. And now you're faced with another big issue, which is a liquidity crunch for the sector. So GST ain't going to do it.
Yeah, absolutely not. We have many ingredients which go towards the success of factor. GST was a very important thing, and they've addressed that, and we are thankful for that. Liquidity crunch is the next big thing which is now ailing the sector, and we hope that that's going to ease up very soon. The biggest problem in the NCR right now is credibility of developers, and that's coupled with the liquidity. So if developers have liquidity and they're able to deliver the projects, that's when the credibility comes back, and that's when the customer sales start happening. So so there are many things which go into it. There are other things like Noida is a big problem. There are stalled projects.
So liquidity seems to be a bigger concern right now than GST. Mr. Niranjan Hiranandani, for me, the way I've been, tracking the sector, I'm saying, can we just get some stability? I mean, now there is this latest news that Mumbai commercial FSI is likely to be halved. Isn't it time for everyone to just back off on real estate and not come out with any new announcements and say, hey, listen, we're not going to fire any fresh salvo?
I don't think so. I think the Prime Minister set the ball rolling in saying housing for all by 2022. And all the things that followed really followed from that angle. So all the time we are focused on how to create more housing stock, how to create affordable housing stock, how to bring liquidity. Let me focus on liquidity. I think what has happened is after the ILFS story, the liquidity in the system has suddenly dried up completely. And I think that is an address. If you understand what happened in 2008 after the Lehman crisis, the Reserve Bank of India had made a provision wherein the NPA of the banks would not be considered NPA in the case of real estate, and they would allow a one-time rollover at the choice of the banks for particular projects. I think a time has come when we need to bring that provision which was issued in 2008 by RBI to come again.
All right, sir. Okay. Well, I don't know whether that will happen. Anyway, we are in a transition. Let's see what the next government which comes to power looks at or sees this problem as. Let me come back to that big GST question now. And Uday, what do you feel? I mean, has this entire exercise that we've seen over the last 20 months of GST really given you that sense that it was meant to be one tax, unified nation, and simple tax. And I mean, there is some merit to what the opposition is saying. The multiple slabs that we are seeing and the back and forth we are doing, and now we have a new one where it's 5% with no input tax credit at all.
So, Manisha, can I just also complete my answer that we gave in the earlier segment? I just wanted to say, when I'm saying palatable, is that this rates of 5 and 1% are for all B2C supplies. And when you have a very high rate of 12 or 18%, it's an inherent incentive to, in a sense, not be compliant. A 5 to or 1% rate, even if, of course, it is without GST, without the credits and so on and so forth, actually is a material incentive to reach higher compliance. And that created obviously a problem on people complying on purchasing from registered people and kind of trying to evade tax on the procurement, which they plugged. So on an overall basis, while it is a clear kind of a diluting of the overall value addition and this, but I don't think as a move it is a fairly smart move to do when you have already plugged the credit one. So that, I think, is one thing that people should appreciate. I mean, for example, 1%, nobody would want to kind of save, obviously, a 1% and not declare that revenue.
I get the compliance point. All right. Now, absolutely. I get that compliance part, at least on affordable housing.
Yeah. Now, on the overall GST rates are concerned, okay, I think we need to be mindful of the fact that there has been a significant reduction of taxes, effective reduction of taxes, from pre-GST rate to the post-GST kind of scenario that you have. And if you have rates in double digits, then it is almost impossible to have a single rate, because again, you can't impose taxes at 15% on a good which is a necessity. It's a very regressive tax.
That's what the finance minister tweeted, and he said you cannot have sin goods and the essentials to be priced at the same thing. So we've got some answer there. This is a conversation we will come back and revisit. Niranjan Hiranandani, Pankaj Bajaj, MS Mani, and Uday Piprikar. Thanks so much for joining me. And of course, all that I can say is that we just need to give some stability, no more shocks, no more changes, and some seriousness from the policymakers, Indian Banking Association, to ensure that funding for project completion comes in, which is dried from NBFCs. Because if more projects get delayed, tinkering with GST rates is not going to bring back the home buyer who's lost a little bit of trust. So we need to complete projects first and foremost.